Imagine a company that's, well, part legacy airline, part cutting-edge tech startup, and part green energy pioneer.
Mhm.
Can it really transform itself into a high-growth powerhouse? Or is it just flying on borrowed time and borrowed money, risking total collapse or maybe spectacular success?
That high-stakes question is precisely what we're diving into today. This is a truly fascinating battleground stock where the outcome for investors, it feels like it's going to be binary.
Welcome to the deep dive. Our mission today is to really extract the most important insights from the sources you've shared with us. We want to help you understand what makes this one of the most compelling and, yeah, high-stakes turnaround stories in the market.
We're talking about Surf Air Mobility, Inc.,
Mm-hmm.
trading on the New York Stock Exchange ticker SRFM. And just for context, as of July 8th, 2025, its closing share price was $4.55.
Okay, let's unpack this unique company. We're going to explore its, let's say, ambitious vision, but also the significant challenges it faces.
Right. We'll break this down into two main parts. First, the foundation, its business, management, and financials.
And then we'll shift gears to look at the market dynamics and, well, its path forward.
So let's jump right into part one, the foundation business, management, and financials.
We begin with Chapter 1, Business Analysis. So at its core, Surf Air Mobility isn't just, an airline. It sounds more like a complex enterprise built on three interconnected pillars.
Yeah, think of it like a strategic three-layered cake, maybe.
Hmm.
The first layer, the base, is the current foundation and where most of the money comes from right now. Air mobility services, we're calling it the legacy operations.
Okay, the legacy bit.
That's right. This pillar covers its wholly owned subsidiaries, Southern Airways Express, and Mukulele Airlines. Together, they operate one of the largest commuter airline networks in the U.S., if you count by scheduled departures.
Huh.
And what's fascinating here, and central to their plans, is that SRFM is also the largest U.S. passenger operator of the Cessna Caravan. That plane is key.
The Caravan, right. And the revenue from this legacy side, it comes from two main streams.
Correct. First, you have scheduled services. These are your standard point-to-point flights. And a significant portion of this actually falls under the Federal Essential Air Service Program, EAS.
EAS, okay. That's the subsidies for smaller places.
Exactly. Crucial subsidies for underserved communities. It offers a stable, although pretty low-margin revenue base.
That's nice.
Last fiscal year, that generated over $90 million.
90 million. Okay, and the other stream.
Then there's on-demand charter. This covers private, sort of ad hoc flights. They're actively tweaking this segment right now, trying to focus more on profitability.
Makes sense.
For fiscal year 2024, that brought in nearly $29 million. So that's their operational base, the existing airline business.
Got it. So, pillar one, legacy airline. Now for the second layer, the digital brain you called it, Surf OS.
Yes, Surf OS. This is positioned as their high-margin, forward-looking technology pillar.
So how does this fit into the big picture, the grand strategy?
Well, Surf OS is an AI-enabled software platform. It's designed to be like the modern operating system for the entire regional aviation industry.
The entire industry. Ambitious.
Very. And critically, its development is backed by a strategic partnership with Palantir Technologies. The AI and data analytics giant.
Palantir. Okay, that's a big name to have on board.
It is. And this isn't just some vague tech idea. They have three flagship products aiming for broad commercial release in 2026.
What are they?
Broker OS for charter brokers,
Oh.
Operator OS for aircraft operators like SRFM's own airlines, actually,
Yeah.
and Owner OS for private aircraft owners. They've even signed up 6 air operators as beta customers already. So there's real traction there.
6 beta customers. Okay, that's progress. So, legacy airline, high-tech software. What's the third pillar that pulls this whole vision together?
The third pillar is electrification. This is their long-term sustainability and, maybe more importantly, cost reduction play.
Ah, the green angle, but also saving money.
Exactly. SRFM is developing its own proprietary hybrid electric and fully electric powertrains. The plan is to retrofit existing aircraft, focusing primarily on that Cessna Grand Caravan we keep mentioning.
The work.
Right. And they have an exclusive relationship with Textron Aviation, who makes Cessna aircraft.
Exclusive. That sounds important.
It is. Their stated goal is pretty bold, a 50% reduction in carbon emissions, and crucially for the business side, up to a 25% cut in direct operating costs.
50% emissions, 25% cost cut. Okay. So how do these three seemingly different pillars actually work together? Because that's the central drama of the stock, as our sources put it. This isn't your typical startup.
Absolutely not. What's truly fascinating and maybe unique here is how they're flipping the typical startup model on its head.
House.
Most tech startups, they face that cold start problem, right? No data, no initial customers. SRFM completely sidesteps it.
Because they already have the airline.
Precisely. Their low-margin legacy airline business acts as a real-world laboratory and the first customer for the high-margin tech and electrification stuff.
Ah, I see.
Those thousands of daily flights, they generate massive amounts of real-world data, perfect for feeding ServOS's AI. And their large captive fleet of Cessna Caravans provides the ideal testbed for developing and proving out the new powertrains.
So they get immediate revenue, even if it's low margin, and the data they need to build the future tech.
Yeah.
That's actually quite clever. A self-reinforcing flywheel, kind of.
Exactly. It's a unique approach.
But even with that operational scale, Surf Air Mobility is still, as you said, a microcap company, right? Pretty small in the grand scheme of the stock market.
That's correct. I mean, while they're a significant player in their niche, they flew over 450,000 passengers back in 2022, they're still a microcap, market cap around $138 million.
Right.
And that reflects its early stage, its current financial losses, and let's be honest, the speculative nature of its tech ventures. Their primary value proposition is really about building this complete ecosystem for future regional air travel.
Using what they already have to prove out the fancy new stuff?
Exactly. Leveraging existing operations to validate high-margin software and cost-saving electrification for the whole industry.
Okay. This raises a pretty important question about the broader industry. What are the market trends? What's the competitive landscape look like for them?
They're targeting the regional air mobility market RAM, for short. Think short-haul flights, maybe 50 to 500 miles, connecting smaller airports that larger airlines often ignore.
Yeah, lots of those around.
Thousands. And this market is projected for, well, explosive growth. The total addressable market, or TAM, is estimated to hit somewhere between $75 billion and maybe $115 billion by 2035.
Wow, that's huge.
It is, growing at a compound annual growth rate of nearly 30% through 2034. It's driven by the need for connectivity over 5,000 public airports in the U.S. alone, plus the push for sustainability and just general advancements in tech.
And competition. It's not just other small airlines, is it? It sounds more complicated.
Oh, definitely not. The competitive landscape is really multifaceted. You've got the legacy regional carriers, the traditional airlines that Southern Airways and Mokulele directly compete with day to day.
Right.
Then you have asset-light charter platforms, companies like Blade Air Mobility, maybe Wheels Up. They have sophisticated booking platforms, apps, but they don't actually own or operate the aircraft themselves.
Okay, so they're tech platforms, not airlines.
Correct. And finally, you have those moonshot competitors, the eVTOL companies we hear so much about.
Ah, the electric air taxis. Joby, Archer, those guys. Are they a direct threat, or is it a different game?
It's an important distinction. Companies like Joby and Archer are developing entirely new, futuristic electric vertical takeoff and landing aircraft. It's very different.
And Surf Air.
This highlights SRFM's key differentiation. They're modifying existing, already certified airframes, specifically the Cessna Caravan. It's arguably a much more pragmatic, maybe faster path to market compared to the billions of dollars and years needed to design and certify a brand new aircraft type from scratch.
So it's sort of an adapt and conquer strategy versus a build from zero approach?
Well put, yes.
It still sounds like they're flying through a regulatory minefield, though, which I guess is also a pretty strong barrier to entry for anyone else trying to compete, right?
Absolutely. The regulatory environment is intensely complex. You've got the FAA, the Federal Aviation Administration, regulating everything: aircraft certification, airline operations, maintenance, safety, the works.
And Surf Air needs special approval for their modified planes.
Yes, for SRFM's plan, getting what's called a supplemental type certificate, or STC, for their electrified Caravan is a major hurdle. It's a long, complex process, but that incredibly high regulatory bar. It also acts as a significant competitive moat for SRFM, especially given their existing experience navigating FAA compliance through Southern and Mokulele.
Okay, so their competitive advantages seem to boil down to this unique position. That pragmatic path to electrification, those key strategic partnerships, Textron and Palantir and their existing operational scale, giving them revenue and data right now.
That's a good summary.
How significant are those partnerships really? Does the Textron deal essentially shut out others from electrifying the Caravan, or is it more like a head start?
The exclusivity with Textron Aviation is a pretty big deal. It essentially means Surf Air Mobility has the sole right, for now, to develop these hybrid electric and fully electric powertrains for the Cessna Grand Caravan,
Wow.
which is an incredibly popular and widely used aircraft in regional aviation.
Yeah.
So this isn't just a head start. It's a significant proprietary advantage in that specific, very important segment.
And Palantir brings the AI muscle.
Right. World-class AI and data analytics expertise feeding directly into SurfOS. It gives them a powerful technological edge. And yeah, that existing operational base is just a huge leg up over many pure play tech startups trying to break into this space.
Okay, that makes sense. Let's move on then to Chapter 2, Management Evaluation. A company with a story this ambitious, this complex, it really needs a strong team at the helm. What can you tell us about their leadership?
Well, the most critical development here, I think, was the appointment of Deanna White as CEO and COO back in December 2024.
Deanna White, okay. What's her background?
Her background seems almost tailor-made for SRFM's dual challenge. She was the CEO and CFO of FlexJet.
FlexJet, the private jet company.
That's the one. So deep aviation operations and turnaround experience there. But before that, she was COO of Kitty Hawk Cora.
Kitty Hawk. Larry Page's flying car company. An eVTOL pioneer.
Exactly. So that brings crucial tech commercialization insights, this combination of traditional aviation ops and future-facing tech expertise in one person. That's a rare and potentially very powerful asset.
That is an interesting mix. And what about the company's history before her arrival? It sounded like there was some financial stress.
Yeah, you could say that. Prior to the new leadership, SRFM definitely had a history of resilience, sticking around, but also significant financial stress. There was a collapsed SPAC deal, some issues with their NYSE listing, and just a consistent need for, frankly, dilutive capital raises, selling more stock to keep the lights on. The new management, like Deanna White, was brought in specifically to address these issues and set a more disciplined path forward.
And how transparent has this new management been about their plans, especially given that challenging history?
Actually, surprisingly transparent. They've laid out a very clear 4-phase transformation plan publicly.
4 phases.
Yep. Phase 1, transformation, which was 2024. Phase 2, optimization, running 2025-2026. Phase 3, expansion 2026-2027. And Phase 4, acceleration 2027 and beyond.
And they report on this.
Yeah. They publicly report milestones against this roadmap. It gives investors a tangible way to track their progress, which builds some credibility.
And we've seen some, well, powerful endorsements alongside this plan, right? Like Palantir consistently increasing its stake.
Exactly. Palantir's steadily increasing stake it's a massive vote of confidence, especially coming from a company like Palantir, known for its, rigorous data analysis. It speaks volumes.
Yeah, that's not insignificant.
And you also had the co-founder, Sudhin Shahani, make a significant $1 million stock purchase back in May 2025. That also signals insider confidence in the plan.
So when it comes to capital allocation, it's pretty clear they're not paying dividends or doing buybacks, right? They're just reinvesting everything into this transformation.
That's right. They are pouring all available capital into, first, operational optimization, getting the airline running better, and then R&D for SurfOS and that electrified powertrain.
And the Southern Airways acquisition was key there.
Absolutely.
Yeah.
That acquisition back in August 2023 was truly transformative. It gave them the operational scale they desperately needed to even attempt this ecosystem build-out.
But there's a cost to raising capital, that dilution you mentioned.
Right. It's crucial to note the history of significant shareholder dilution. They keep issuing new shares to raise cash, like the $5 million raise in April 2025, another $27 million in June 2025. This is a key risk for investors because it means each existing share represents a smaller piece of the company.
Okay. Given all this heavy investment, how do their returns on invested capital, ROIC, look right now? Are they actually creating value with all this spending, or maybe the opposite?
Well, currently their ROIC is deeply negative. Over the trailing 12 months, it's nearly minus 30%.
Minus 30. Ouch.
Yeah. It means they are currently destroying value, literally losing money on the capital they invest. The entire bull case hinges on this being a temporary phase.
A very temporary phase, hopefully.
Right, with future high margin returns eventually coming from SurfOS and the cost savings from electrification. An investment in SRFM today is a direct bet on a dramatic and frankly unproven pivot to value creation.
Okay, let's transition now to Chapter 3, Financial Analysis. What are the key financial metrics telling us about Surf Air Mobility today?
Well, first off, as we mentioned, it's a microcap stock, market cap around $138 million. That alone flags it as a higher volatility, higher risk investment compared to larger companies.
But the revenue growth has been, well, explosive, right? That seems to be a really compelling part of their story.
It absolutely has been. I mean, you look at the numbers. From just $7.5 million in 2020, revenue soared to nearly $119.5 million in 2024.
Huge jump.
Yeah, including a massive 97.4% growth spurt in 2024 alone. A lot of that, of course, was driven by acquiring Southern Airways. This explosive top-line growth is definitely the bait, as our sources put it. It catches your eye.
Okay, the bait. But the profit margins, they tell a very different and much tougher story.
They really do. They are the heart of the bear case. The trailing 12-month gross margin is razor thin, hovering around just 5%. It was actually negative in the first quarter of 2025.
Negative gross margin, so the cost of just providing the service was more than the revenue.
In that quarter, yes. And it gets worse. Trailing 12-month operating margin is deeply negative, almost minus 40%. They're losing nearly 40 cents for every single dollar of sales just on operations.
Wow.
And the net profit margin, even worse. Over minus 50%. They're losing more than half their revenue after all expenses and taxes are accounted for. These numbers starkly illustrate their current severe unprofitability.
So the whole investment thesis just has to rely on that transformation plan working and drastically improving these margins down the line.
Completely. There's no other way to justify the current setup.
And that leads directly to cash flow. Or, in this case, probably significant cash burn.
Exactly. Their free cash flow generation has been consistently and significantly negative. Over the trailing 12 months, they burned through nearly $70 million in free cash flow.
$70 million.
Yeah. And that kind of cash burn is precisely why they need those repeated capital raises we discussed earlier, the ones that dilute existing shareholders.
So digging into overall financial stability, they have this consistent history of big net losses, almost $75 million lost in 2024, another $18.5 million just in the first quarter of 2025.
Right. No profit in sight yet.
And their debt-to-equity ratio, you said it isn't even meaningful because they have negative shareholder equity. Can you explain what that means practically?
Sure. Negative shareholder equity is a major red flag. It essentially means the company's total liabilities exceed its total assets. If they were forced to sell off everything they own today and pay off all their debts, they would still owe money.
Okay, that sounds bad.
It indicates a very precarious financial state and significant insolvency risk. Their total debt stands at around $91 million. And another indicator, the current ratio, which measures short-term liquidity, is extremely low at 0.22.
Meaning they don't have much cash or easily convertible assets to cover near-term bills.
Precisely. It highlights their financial fragility and extreme dependence on raising new financing just to keep the operations going. And just to reiterate, they don't pay a dividend, haven't ever, and aren't expected to anytime soon.
So what does this all mean for their valuation? Since they have negative earnings, we can't use a standard price-to-earnings ratio, right?
Correct. PE is useless here. We typically look at the price to sales, or PS ratio in these cases. For Surf Air Mobility, it's approximately 1.23.
1.23. So investors are paying $1.23 for every dollar of SRFM's annual sales. How does that compare?
Well, comparing it is tricky because their model is unique. But given those deeply negative margins we just discussed, a PS of 1.23 clearly reflects a bet entirely on the future. It's about what the company could become, not its present profitability.
Okay. And what about trying to figure out an intrinsic value, like using a discounted cash flow or DCF model? How would you even attempt that for a company burning cash like this?
Yeah, doing a DCF for a company like SRFM is highly speculative, almost an academic exercise at this point, because it relies on forecasting future cash flows that are currently negative and, frankly, highly uncertain.
Right.
You're estimating value based on expected future positive cash flows, then discounting them back to today's value. One third-party model we saw suggested a potential base case of just under $7.40 per share if the bull case fully plays out successfully.
A big if.
A huge if. That $7.40 implies some potential undervaluation from the current $4.55 price. But I have to stress, this is purely an illustration, not a prediction. It's incredibly sensitive to the inputs.
What kind of assumptions would you need to make to get to that number?
Oh, very aggressive ones. You'd have to assume extremely high revenue growth continues for the next 5-7 years, like close to that 30% market growth rate, followed by a gradual tapering. And crucially, you'd need to assume a dramatic, almost heroic improvement in profit margins that just isn't visible yet.
Plus a high discount rate to account for the risk.
Exactly. You need to use a very high discount rate, probably 15 to 20% or even more, reflecting the extreme risk involved in this turnaround story.
So the financial summary really paints this picture of a company in a high-stakes race against the clock.
It really does. The income statement shows that tantalizing explosive growth potential, that's the bait.
Right.
But the balance sheet and the cash flow statement clearly show a very limited financial runway. The negative margins, the high cash burn, the weak balance sheet with negative equity. Those are the hooks that highlight the inherent serious risks. This makes the stock exceptionally sensitive to any news, good or bad, and progress or lack thereof on their transformation plan. The underlying narrative is what's largely supporting its current valuation, not the fundamentals.
All right, that sets the stage perfectly. Let's move into part 2, market dynamics and the path forward.
Okay, first up in this part is Chapter 4, Market Sentiment.
So what's Wall Street's take? Do the analysts covering Surf Air Mobility actually think this ambitious story will play out? What's the feeling?
Well, there seems to be a sort of cautious optimism among the analysts who follow it. The consensus rating generally leans towards a buy or moderate buy.
Okay, positive leaning. What about price targets?
The average 12-month price target, based on a snapshot from early July, was approximately $5.56. That suggests potential upside of over 35% from its price at that time, which was around $4.10 then, now $4.55.
35% upside potential.
But that average masks a very wide range of forecasts. We saw targets from as low as $3 all the way up to $12.
$3 to $12, that's a huge spread.
It really is.
Yeah.
And it perfectly reflects the significant uncertainty surrounding the company and that binary outcome nature we keep talking about. Analysts are clearly divided on whether they can actually pull this off.
So given that uncertainty, news flow must have a big, almost immediate impact on the share price, right?
Oh, absolutely. A significant and immediate impact. We've seen sharp upward moves in the stock after specific announcements, things like that $27 million direct offering they secured, any news about Palantir increasing its stake, or positive updates on meeting milestones in their transformation plan.
And the media narrative focuses on...
Mostly on the forward-looking story, the partnerships, the potential of electrification, the idea of market disruption, less focus on the current, much more challenging financials.
Okay. And what about other market indicators like short interest? Are there a lot of people betting against this stock?
The short interest is exceptionally high. As of mid-June 2025, there were 1.40 million shares sold short. That represents over 12% of the total shares available for trading, the float.
12% is very high.
It is. And bearish sentiment had actually been intensifying, up nearly 70% from the previous month's report, so more people were betting against it.
But is there a risk of a short squeeze?
Potentially. The days to cover ratio is very low at just 0.5. That means, in theory, it would take only half a day of average trading volume for all the short sellers to buy back their shares. So if there's significant positive news, shorts might rush to cover, potentially driving the price up rapidly.
Interesting dynamic. But technically, the stock price itself has been trending upwards recently, right? Trading above its moving averages. That seems like a contradiction to the high short interest.
Yes, that's the other side of the coin. As of early July, it was trading significantly above its 50-day simple moving average, which was somewhere between $2.59 and $3.58. And it was comfortably above its 200-day moving average of $3.02.
So technically a bullish uptrend.
Generally, yes. Trading above those key averages indicates a bullish short-term and potentially long-term uptrend, technically speaking, which creates this fascinating disconnect.
So you have these bleak underlying financials, but you have bullish price momentum, generally positive analyst views despite the uncertainty, and extremely high short interest. This is that battleground stock scenario perfectly encapsulated.
Precisely. It creates a real narrative tug-of-war. You've got the strong, appealing story of transformation pulling one way, and the hard current financial realities pulling the other.
And that explains the volatility.
Exactly. It explains the stock's exceptionally high volatility. Its beta, a measure of volatility relative to the market, is somewhere between 2.9 and 3.75, which is very high. An investment here is truly a bet on which narrative ultimately wins out in the market's perception.
That brings us nicely to Chapter 5, ownership structure. Who actually owns Surf Air Mobility? Is it mostly big institutions playing this game or individual investors?
Well, the ownership structure is actually quite unusual, especially for a company listed on the NYSE. Institutional ownership is relatively low. Depending on the source, it ranges from about 5.3% up to maybe 18.7%.
Pretty low. So who's the biggest holder?
The most important institutional shareholder isn't a typical mutual fund or hedge fund, it's Palantir Technologies itself.
Palantir again. How much do they own?
They hold somewhere between 13% and 19% of the company, making them by far the largest single shareholder. And as we discussed, that's a massive vote of confidence coming from a key strategic partner that really understands data and technology.
Okay. What about insiders, management founders? Are they buying or selling shares?
Insider ownership sits roughly between 8% and 9.3%. We've seen some clear bullish signals, like Palantir's active buying. They bought over 1 million shares on June 17th, 2025, for example. And that $1 million purchase by co-founder Sudhin Shahani back in May.
Any sell?
There has been some selling too, yes. Director Tyler Painter sold about $184,000 worth of stock in late June 2025. However, it's important context that this was done under a prearranged Rule 10b-5-1 trading plan.
Ah, the scheduled selling plan.
Right. It's a mechanism insiders use to sell shares according to a preset schedule, often for personal financial planning, diversification, tax reasons. It avoids accusations of trading on inside information, so it's not necessarily indicative of a negative outlook on the company itself.
Okay.
Co-founder Sudhin Shahani also had a smaller sale, about 75,000 shares, in early June 2025. So a bit of both buying and selling from insiders.
But the most striking thing about the ownership, and arguably a key driver of that volatility we talked about, is the retail investor base.
This is absolutely critical to understanding SRFM's stock behavior. Retail investors, individual investors like you and me, hold the vast majority of the shares. Estimates put it at approximately 58% to 59%.
Almost 60% retail. Wow.
Yeah, it means the stock price is highly susceptible to retail sentiment, shifts in momentum, what's being talked about on social media, headline news, you name it.
So the story is even more crucial.
Exactly. It explains why the stock is so volatile and why the narrative is so vital to its valuation. And it also means that actions by major holders, especially Palantir, carry outsized weight and can trigger significant price movements because that retail base often follows the lead of perceived smart money.
Makes perfect sense.
Yeah.
Okay, let's talk risk. Chapter 6, risk assessment, using a kind of SWOT analysis framework, strengths, weaknesses, opportunities, threats. What would you say are Surf Air Mobility's core strengths right now?
All right, strengths. First, their existing operational scale, having that large commuter airline base already running, is huge. Second, their pragmatic electrification strategy, focusing on retrofitting the existing proven Cessna Grand Caravan, which should mean a faster, cheaper path to certification, the STC. Third, those key strategic partnerships we keep mentioning, the exclusive deals with Textron Aviation and Palantir Technologies. And fourth, the experienced new leadership, particularly Deanna White, whose unique dual background seems perfectly suited for this complex challenge.
Okay, those are solid points. But the weaknesses, they seem equally stark, don't they? Especially looking back at the financials.
They are. Financial fragility is probably weakness number one. Persistent net losses, those deeply negative margins, the significant cash burn, it's all concerning.
And the balance sheet.
Right, a very weak balance sheet. Significant debt load, that troubling negative shareholder equity we discussed, which points towards insolvency risk. This directly leads to another weakness, their heavy dependence on external capital, which means relying on those dilutive stock offerings.
And the tech isn't proven yet at scale.
Exactly. SurfOS and the electrified powertrain are still largely in development, unproven at full commercial scale. That's a major internal limitation right now.
Okay. What about the opportunities ahead? The market certainly sounds big enough to support significant growth if they can execute.
Oh, the opportunities are definitely there. That total addressable market for regional air mobility is massive, potentially over $100 billion by 2035. If they can successfully commercialize SurfOS, that represents a potentially high-margin, highly scalable software-as-a-service business.
The SaaS model.
Right. Plus, there's potential for future government support subsidies, green initiatives, tax credits building on the stable EAS revenue they already get.
Okay. And the threats. Beyond just the intense competition from legacy carriers, charter platforms, and those eVTOL startups, what else could realistically derail them?
I think execution risk is arguably the single greatest threat. Can they actually execute this incredibly complex, multi-phase transformation plan on time and within budget?
Yeah.
It's a monumental task.
Yeah, that seems key.
Regulatory hurdles are another big one. Actually, obtaining that FAA supplemental type certificate for their powertrain is not guaranteed and could face significant delays or challenges.
And how about broader macroeconomic factors? Things like inflation, interest rates. Could those hurt a company like Surf Air Mobility, which is already financially stressed?
Absolutely. Inflation drives up their costs, labor, maintenance, parts, which could squeeze those already razor-thin margins even further and limit their ability to raise prices.
And interest rates.
Higher interest rates directly increase the cost of servicing their existing debt and, crucially, make it more expensive to raise new capital, which they clearly need for investment and expansion. That's a big headwind for a company so reliant on external financing.
We also saw a mention in the sources about new U.S. imposed tariffs from 2025. Could that impact them?
Yeah, the new 10% tariff on imported aircraft and parts implemented in April 2025. While SRFM primarily uses U.S.-made Cessna aircraft, some components for their hybrid electric powertrain could potentially be sourced international.
So it could increase costs for the electrification part.
It could, yes. The company stated they didn't anticipate a significant impact in 2025, but it's definitely a risk factor to monitor going forward, especially as they scale up powertrain production.
So when you weigh it all, internal versus external risks.
Ultimately, while the external threats, competition, regulation, macro factors are very real, Surf Air Mobility's unique strategy actually offers some shielding, particularly the pragmatic approach compared to eVTOLs. The most profound risks, I think, are internal: their precarious financial position, and the sheer monumental task of executing that transformation plan. The investment thesis really lives or dies on management's ability to deliver.
Okay. Let's try to bring it all together now in Chapter 7, Conclusion. Can you give us a concise synthesis of the bull case for Surf Air Mobility? Why would someone invest?
Sure. The bull case paints this picture of pragmatic disruption. They're tackling a massive regional air mobility market. They're cleverly leveraging their existing airline operations as both a laboratory and a first customer for two potentially high-margin future businesses: the SurfOS software platform and the cost-saving hybrid electric powertrains.
Okay.
This whole vision is validated, or at least strongly supported, by powerful, exclusive partnerships with industry giants Palantir and Textron, and is now being led by an experienced new CEO with a seemingly perfect background. The ultimate potential is for SRFM to become the essential technological backbone for the entire regional aviation sector.
That's the dream scenario.
Yeah.
Now, flip side, the bear case. What's the argument against investing, the major downside here?
Well, the bear case is starkly financial. This is a financially distressed company burning through cash rapidly with a very weak balance sheet weighed down by significant debt and that negative shareholder equity.
Right.
Its core airline operations are currently unprofitable, and its potentially game-changing technology is still unproven commercially and likely years away from generating significant revenue, let alone profit. They have a history of diluting shareholders to survive. It's a high-stakes race against time, fraught with enormous execution risk, facing intense competition and macroeconomic headwinds. The risk of substantial or even total loss of capital is very, very real here.
Okay, so pulling back to the valuation, what does this all mean for the stock price today?
Well, as we discussed, any intrinsic valuation like a DCF is highly speculative at this stage. That educational model we mentioned suggested a wide potential range, with one base case estimating just under $7 per share if, and it's a big if, the bull case fully materializes. But again, that figure is extremely sensitive to aggressive assumptions about future growth and massive margin improvement that are far from guaranteed.
So as of July 8, 2025, with the share price sitting at $4.55, it really just reflects this deep division in the market, doesn't it?
It absolutely does. It's trading well below those optimistic blue sky intrinsic value estimates, but also significantly above any valuation you could possibly justify based purely on its current dismal financials. Making SRFM a classic, high-risk, high-reward, speculative investment. The market sentiment, as we saw, is a real tug-of-war. And the outcome feels, as we said right at the top, incredibly binary. Spectacular success could mean it's significantly undervalued right now, but failure could easily mean a significant, perhaps even total loss for investors. It's a pure bet on a very difficult, very high-stakes transformation actually succeeding against the odds.
So what does this all mean for you listening? If Surf Air Mobility does successfully navigate this incredible transformation, how might it genuinely change the way we think about regional air travel, about connectivity in smaller communities across the country?
Or, if it falters, if it doesn't make it, what does that tell us about the immense challenges, the sheer difficulty of trying to innovate within these highly regulated, incredibly capital-intensive industries like aviation? Something to think about.
Absolutely. If you found this deep dive valuable and you want more insights like this, please do like this video and subscribe to the Stock Analytics AI YouTube channel.
And remember, members can add stock suggestions for future deep dives right there in the comments section, and we prioritize those requests. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those deep dives for just €4.99 a month.
Also, if you'd like a one-off deep dive on a specific ticker that's caught your eye, you can support us by dropping a super thanks right here on the video.
And finally, the important disclaimer. This analysis was generated by an AI system purely for educational purposes. It should definitely not be considered financial advice.
Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.